Your property is profitable, so why did the lender say no? The DSCR problem explained. So you own or you're looking to buy a commercial property that generates positive cash flow, and the rent roll looks good, and expenses appear manageable, and the property produces a profit. But then you apply for a commercial real estate loan, and the lender runs the numbers and just says no. So what happened? Well, one of the most common explanations is debt service coverage ratio, or DSCR. So a property that can be profitable from an investor's perspective while still failing a lender's underwriting requirements. And understanding that distinction can help commercial real estate investors structure acquisitions and refinances and cash out transactions more effectively. So what is DSCR in commercial real estate? Debt service coverage ratio, or DSCR, measures the relationship between a property's net operating income, or NOI, and its required annual debt payments. And the basic formula is DSCR equals net operating income divided by your annual debt service. So say, for example, suppose a commercial property generates $150,000 in net operating income a year, and the annual loan payments are $120,000. So the DSCR would be the 150 divided by 120, and that's a 1.25 ratio. And a 1.25 ratio means the property generates $1.25 of income for every dollar in debt service requirements. And that additional 25 cents is the lender's financial cushion, as well as the investor's financial cushion. So why lenders care so much about DSCR? Well, a commercial lender isn't simply asking whether your property makes money. The lender is asking, does your property generate enough money to sustain the loan that you're asking for? And that's a very different question, is my point. In commercial real estate, you're going to experience vacancies and unexpected repairs and tenant turnover and tax increases and insurance increases and changes in your operating expenses. So as lenders generally want a margin of safety between property income and your mortgage payments. And that required DSCR varies by lender and the property type and the transaction and the risk profile. However, 1.2 to 1.25 is generally a comfortable range for many commercial real estate transactions, while some banks and credit unions may require at least 1.35. So this is why you should assume and never assume that a property is going to qualify based solely on the value. So let's talk about the $2 million property that can't support a $1.5 million loan. So let's do a simplified example. Say an investor owns a property that's worth about $2 million and he wants to get $1.5 million loan on it. And at first glance, that's 75% loan to value. So that sounds reasonable. It's kind of your top end. But suppose the property's lender adjusted net operating income is only $105,000 and the proposed loan requires $100,000 in debt service. So 105 divided by 100, it's only a 1.05 DSCR. So the property technically produces enough NOI to make the payments, but if the lender requires a higher debt coverage ratio, the loan just doesn't work. Well, to support $100,000 of debt service, you probably want a 1.25 debt service coverage ratio. So 1.25 times 100,000, you need 125,000 NOI. So basically the property is short 20,000 in income, is my point. And that can cause the lender to reduce the loan amount or just decline the request entirely. So LTV and DSCR do work together. And this is one of the most important concepts for commercial borrowers to understand. Your loan may be constrained by multiple different calculations, one being loan to value, or LTV. So how much is the property worth relative to the loan amount? And also debt service coverage ratio, or DSCR. How much debt can the property support, or property's cash flow support? And the lender will generally size the loan around whichever constraint is the lower of the two, along with any additional underwriting requirements. So a property might support 75% loan to value based on value, but only 65% based on cash flow. In that the situation, DSCR and not loan to value is what's going to determine your proceeds. So why your NOI may be different from the lender's NOI. And another frequent surprise occurs when the borrower and the lender calculate the NOI differently. And you may believe the property generates 200,000 NOI, but when the lender underwrites it, they're coming up with 165,000. Well, the lender may just normalize or adjust your expense items. Like you may be missing vacancy and credit loss, or management fees, or repairs and maintenance, or property taxes or insurance, or maybe you're missing replacement reserves, or you have non-recurring income, or there are any owner-paid expenses or any below-market expenses. And the lender's job is to determine sustainable cash flow and compare that with what's appearing on your profit and loss statement. And that difference can materially affect your debt service coverage ratio. And higher interest rates can also create a DSCR problem. And that's another variable borrowers sometimes overlook is the interest rate. So imagine that a property's NOI has not changed, but if the new mortgages would require significantly higher annual loan payments than the old loan, your DSCR is going to decline automatically as a result. So say, for example, 150,000 NOI divided by 100,000 in debt service is 1.5 DSCR. But if higher rates push that annual debt service to 125, 150 divided by 125 is 1.2 DSCR. Same property, same NOI, but completely different underwriting result is my point. And that is one reason that refinancing can become difficult even when the property's operating performance still remains strong. So what can you do when the DSCR is too low? Well, a DSCR problem doesn't necessarily mean the transaction is dead. And depending on the property and the loan request, possible solutions may include just reducing the loan amount. And lower principal generally means lower debt service. You can also stretch the amortization. So a longer amortization schedule can also reduce your required monthly payments. Or we could shop to find you a more competitive interest rate. And lower debt service can improve your DCR too. But you can always improve your property's NOI. So increasing sustainable income or reducing legitimate expenses can also increase your coverage. And that's the most one you can control. We can evaluate different lenders and different underwriting criteria and amortizations and pricing and reserve requirements and risk tolerances as backup. We can consider alternative financing, and depending on the transaction, borrowers may have conventional bank or credit union or bridge or SBA or CMBS or agency or debt fund or other alternatives. And the key is underwriting the actual underwriting constraint before we try to solve that problem. So why shopping for commercial lenders matters. And commercial lending isn't standardized like many borrowers expect. And two lenders can review the same property and reach different conclusions because they may have different DSCR requirements, or interest rates, or amortization periods, or expense assumptions, or vacancy factors, or replacement reserves, or loan-to-value limits, or recourse requirements, or general property type guidelines. And that's why commercial borrowers benefit from comparing loan structures and not merely just advertised interest rates. So a lender offering a slightly lower rate isn't necessarily offering the best execution if another lender can provide better proceeds or a longer amortization or less prepayment terms or more flexibility. So run the DSCR before you make that offer. And for investors acquiring commercial real estate, DSCR analysis should happen before the purchase contract becomes difficult to unwind. So really, you should understand the property's realistic NOI, the likely what lender adjusted NOI is going to look like, the expected interest rate, the amortization, the debt service, your debt service coverage ratio, and also the maximum loan supported by your DSCR, but also by your LTV. And that analysis provides a much clearer picture of how much equity you may actually need. So the bottom line is that a profitable commercial property does not automatically qualify for financing. And profitability tells you whether the property generates income. DSCR tells the lender whether that income adequately supports the proposed debt. So understanding that distinction before approaching lenders can save you considerable time and prevent unpleasant surprises later in a transaction. My name is Bill Rapp. I'm with the CommLoan Empower Program, and we help commercial real estate investors and business owners evaluate their financing options across a broad commercial lending marketplace. So instead of asking only, hey, what's the rate? Start with a more important question. How is this lender going to size my loan? And that answer can determine whether your transaction actually closes. And that's what I'm here for, to help you close your deals. My name is Bill Rapp. You can visit my website, billrapp.comloan.com. That is it for the day. Thank you for your time.